Have you ever wondered how interest rates are predicted? Well, you're not alone. Interest rates, those percentages that seem to dictate so much of our financial lives, are a bit of an enigma. They're the invisible strings that control everything from the growth of your savings account to the cost of your monthly mortgage payments. Moreover, these rates aren't static. They ebb and flow like the tide, changing with the economic climate. Predicting these fluctuations is a complex task, akin to forecasting the weather, and just as pivotal. It involves a careful understanding of various factors and indicators, a sort of financial meteorology, if you will. And why is this important, you might ask? Well, accurate predictions can mean the difference between financial success and hardship. They can help investors make informed decisions, and ordinary people navigate the turbulent waters of finance. Now you might be wondering, what are these factors that influence interest rate predictions? Let's delve into that next. So, what really influences these interest rate predictions? Well, let's delve in and see. Four main factors tend to sway the tide of interest rates: inflation, economic growth, government debt, and monetary policy. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation is high, interest rates often rise to keep the economy from overheating. Next, economic growth. When the economy is booming, demand for loans increases, pushing interest rates up. Conversely, in a sluggish economy, demand for loans decreases, causing interest rates to fall. Now, government debt. High levels of government debt can lead to higher interest rates, as governments may need to raise rates to attract investors. Lastly, monetary policy set by central banks plays a critical role. They can adjust interest rates to control inflation and stabilize the economy. Understanding these factors can help us better predict where interest rates are headed. But how is this prediction actually done? Predicting interest rates is more of an art than a science. You see, economists use a variety of models to predict interest rates. These models are intricate machines, piecing together a myriad of factors we discussed earlier: economic growth, inflation, government borrowing, and international influences, to name but a few. However, these models are not crystal balls. They are not perfect. They do not provide absolute certainty. Instead, they provide us with a range of probable outcomes. This is because they are based on assumptions about the future, and the future, as we all know, is inherently uncertain. So we're left with a delicate balance, a dance between data and interpretation. Each economist, each model offers a unique perspective, a unique prediction. It's a fascinating process full of nuance and complexity. So while we can never be 100% sure about future interest rates, we can make educated predictions. So, why should you care about interest rate predictions? Well, let's put it this way. Changes in interest rates can have a significant impact on your personal finances. Higher interest rates, for instance, can make borrowing more costly. That dream house or car you've been eyeing might suddenly become less affordable if the cost of your mortgage or car loan increases. On the other hand, low interest rates might make your savings account less attractive. The money you've been diligently setting aside might not grow as quickly as you'd like, potentially affecting your future financial plans. But don't worry, navigating these changing tides isn't as daunting as it seems. Stay informed, keep an eye on economic trends, and consider seeking advice from financial experts. These simple steps can help you make sound financial decisions, regardless of where the interest rates might be heading. In conclusion, while predicting interest rates can be complex, understanding the process can help you make better financial decisions. Remember, knowledge is power,